Welcome to the second chapter of the official trading course from Forex Tester Online. It's giveaway time, and not only one giveaway, we are giving out 42 accounts of free Forex Tester Online accounts, so you can use Forex Tester Online completely free for everybody that enters the giveaway on this free trading course. And the conditions are really simple. Let's check them through. Basically, we need to subscribe to the channel and leave a comment under the video to enter. So basically there's 6 videos, so there's 6 entries that you can get. You could win a lifetime license basically for all your life, or basically or 1 year subscription or 1 month subscription. Each video is going to have 1 lifetime, 1 year subscription and 5 monthly subscriptions. So basically in total there's 42 giveaways that you can enter, and basically you can comment on every single video of this trading course, so it's excellent. Each video of this course will have its own giveaway, as I mentioned, and you need to comment under to basically have a chance. On top of that, if you comment with different comments, especially comments that features that you like Forex Tester Online or why you want Forex Tester Online, please comment down below. And basically if you have more than 1 comment, then you have more than 1 chance to win this giveaway. As well, really important, we need to register for a free account in Forex Tester Online, and to do this is really simple. Basically we only need to come down here where we can see our plans, and here we come to free demo, and we just need to enter with our Google account, Microsoft account, or just register with a normal email. And this is obviously is important so you can enter this giveaway. And last but not least, really important, you need to have an email on your YouTube profile. It can be any email, it doesn't need to be your personal email or anything like that, but preferably the email that you've actually used to register for this free demo, because this email is the one that we're going to use to be able to contact you. So to resume everything, what we need to do is basically subscribe to the channel, like the video, comment the video why you want Forex Tester Online, and register for this free account that I've just showed you at the moment. And this way you'll be entering in this giveaway. Obviously, you can have all this information down in the description so you don't have any doubts at all. And we are going to finish this giveaway on September the 6th. And the draw time, basically we're going to do a massive live stream here on our channel on the September the 9th, where I'm going to announce all these winners. And like I said, really important, if you don't have a public email on your YouTube channel, we can't reach out to you. So please, if you are a winner, we have 7 days, or in this case you have 7 days to put your email on your YouTube profile as a contact method, so we can reach out to you and give you your free account. So good luck to everyone, and let's continue with the video. And today what we're going to learn is technical analysis to understand how the market moves and how we can predict the next movements. So let's go straight in. We are in a complete fresh chart, and in this case I've picked the euro against the dollar. And this is the meaning, because I live in Europe. So basically when the London session opens and all the euro exchanges open, then obviously I'm going to be interested in trading in that session, because there's going to be more volume. And if there's more volume, that means I have more opportunities to actually get a good trade. So in this case, that's why I'm trading the euro, because I'm going to go here to Forex Tester Online, go to the London session, and now my trading day would start. So I'll start trading at 8 o'clock in the morning. And this is where I would start analyzing the market. Obviously, we need to understand that when we actually start trading, we are going to be using a trading strategy. And we need to build a trading strategy based on technical analysis, on basically finding our edge, looking at the analytics. And this is the importance of backtesting, because at the end of the day, if we don't backtest, we don't have any knowledge of what our analytics are. And obviously that leads to a lack of confidence, because we don't know if what we're doing actually works. And this is the only way of actually measuring the way that we trade, and to actually know if we have a real edge in the market. But all this, we're going to explain it in future videos. Basically what we're going to focus now is on how to understand the technical analysis and know what it is. Well, first of all, we need to talk about candlesticks. What is a candlestick? Candlestick is every candle that you see here. This red line down is a candlestick, and inside this candlestick there's more candlesticks. And this is where we come into time frames, because we have different time frames of candlesticks. So basically right now we're sitting on the 15-minute time frame. What this means is that every candle takes 15 minutes to close. Okay, so all these candles have taken 15 minutes. So all these candles have been the Asian session since 12 o'clock to 8 o'clock in the morning. So if we go now to a 5-minute chart, basically what we're going to see is 5-minute candlesticks. Every candle has taken 5 minutes to close. And as you can see here, obviously they are more candles because they take less time to close. And then we can go even down to 1-minute candlesticks, where basically we're going to be looking at 1-minute candles, and all these candles take 1 minute to close. So based on what trading style we're going to use, we are going to use one time frame or the other, because there's different trading styles. Okay, we have, first of all, we have scalping, that this is basically taking really quick trades that can go from 1 minute, basically trades that last 1 minute, to 5 minutes, 10 minutes, half an hour, even up to 1 hour. On top of that, we have day trading. Day trading is my trading style, and it's basically taking most of the times 1 or 2 trades a day, and focusing on, like I say, trades that can last from 1 hour, 2 hours, 3 hours. More along that, I don't take the actual closer positions. And then we can go to swing trading. Swing trading is basically, it's more similar as buying stocks and holding them, because we can actually hold trades open for maybe a week or 2 weeks. But that depends on your trading style, on how you feel, and all this gets covered in the psychology part of this trading course. So obviously don't miss this out. So we're not going to go more deeper in that, because obviously what I want to explain today is how the actual market moves. So now we know what a candlestick is. Basically, we can see that if we have one daily candle, that in this case is the previous day candle was a doji. So basically this is a candlestick formation, okay, because we have different candlestick patterns that we can as well use in our favor to find our edge. And this candlestick here is a doji. If you have any issues finding these type of candlesticks, if we can come to indicators in Forex Tester Online, we have candlestick patterns. We can find all the candlesticks that exist, and if we select one, let's say inside bar, then when we get an inside bar, we're basically going to see an arrow showing that this is a candle. An inside bar, basically it means that the previous candle is bigger than the next one after closing. So you can see this candle here is smaller than this candle. That's why it's called an inside bar. But obviously we're not going to go into this right now, because obviously candlestick patterns, there's a lot of them and we don't need to use them all. Normally I would select 1 or 2 based on my trading strategy. What we can see here, let's say we're going to mark out the previous day high and low. So let's say this one here and this one there. This is going to be our previous day low. And just by looking at this candle, we can see that the candle pushed up and then it pushed down again. Because basically when we look at candlesticks, we can see that we have the opening price, okay, that is the previous price close. Then these 2 wicks are the maximum and the minimum of that candle they actually reached, and then we have the closing that is here. So just by seeing this candle, I can see that basically that day what the price did, it pushed either lower or high up and then pushed back down. So what I know for 100% that it pushed up and then came back down. So if we come now, let's say to a 1 hour chart, we'll be able to see the exact same pattern but in market structure. So as you can see here, what it did is push high up and then pushed down. So this is basically what it's done. And obviously this is not, we can't identify what the next market move is just by watching this, but we need to understand that it's all matched together, and what we see in the 1 hour candlestick, we're going to see it in the 1 minute candlestick in a different way, but it's always going to be the same message. So now what we need to do is think about the market structure, okay? And market structure combines with support and resistance. So the market structure, basically, it always moves in the same way. What we're going to see is a push up, we're going to see a retracement, a push higher, a retracement, a push higher, a retracement. This is a trend, okay? Because basically, always when the price actually comes back, it's always going to be higher than the last low, okay? And this is how we see the low, the high, the lower high, the higher high, the lower high, the higher high. Okay, this is how we actually identify a trend. There's different ways of identifying a trend. We can use indicators like a moving average, an RSI, a MACD, and things like that. But in this case, based on market structure, pure technical analysis, this is how we identify a trend. So if we see this in the market, we know that the price is pushing higher. That basically when the price comes back down, it doesn't have enough strength to actually break this level here. And this level here was what initiated the push to break this high here. So basically has been a lot of volume entered, and if the volume of the sellers isn't bigger than the volume of the buyers at this spot here, then the price is not going to be able to break down. And this is where we come to the second concept of the actual market structure, that is a market structure break. So basically, if the price comes finally down here and breaks through this level, this is called a BOS, so a break of structure. And this basically means that the volume of the sellers has been higher than the buyers. And this is where we can expect movements like the price comes here, pushes up again because it's always going to retrace, and then continues downwind, creating a new lower low. Okay, and creating this case a higher low. And then we can expect things like this to happen, and then it'll break up again, create another market structure, and then continue up, then come back down again. And sometimes we can see things like a double market structure shift where it breaks the high here and the low here. This is more a manipulation of the market, where basically there's been a lot of volume entered and it's gone crazy, and obviously it can break this harmony, this structure that we're actually building. And this is where we can actually find support and resistance, because obviously support and resistance are basically levels where the price had some type of support or it's had a resistance. So the supports are going to be below and the resistance are going to be higher. You don't need to remember the names, you just remember the concept of that they are levels that price needs to break. So if we have a price that is uptrending like this, okay, we basically can see that this here is a support and this above is a resistance. Support and resistance are made to break. So we need to understand that some are going to hold and some are going to break. But we need to understand as well that a support, a resistance that has been broken turns into a support of the price. So when the price comes down, it can react to this resistance and go up. So basically what we need to understand is that the support and resistance aren't perfect, and the price isn't going to stop there, limit, like really on the pip, on the tick. It's going to be a range where the price can turn around. And that's what we need to understand, that when we mark out this zone here, the price can come down, go below it, react to a zone that could be somewhere around here, and then go up. But the primary support and resistance that we're always going to have is the low of the movement and the high of the movement. If it's in an uptrend and it breaks the resistance, then basically it's going to be turning into a support, and then we can look for a trade to maybe buy. So if we look at this at the real market, obviously it's a bit harder to actually identify, but we can still see the exact pattern. So if we look at this trend, downtrend here, okay, we'll be able to see that we have a market structure inside where we can see that this was the low, and this low got broken at this point here, creating an impulse, a small retracement, an impulse, and then it started retracing up, and finally it broke through this level here, creating this low here. Then the price came back down, pushed higher up, okay, breaking this high here, and then obviously the price coming down here and breaking this little low there. So now we're in a downtrend again, and obviously then after that the price came lower, breaking this level here, okay, and we had some market structure forming here, and then it broke above, breaking this level, retraced again and went higher, so breaking this level, retraced higher, breaking this level. So this is how the market structure you'll be able to identify it in the real markets. Obviously, it's not something that you're going to be able to identify since the minute number one. You need to take your time, understand it. At the end of the day, trading isn't a way to rush money. It's actually a career that you need to be in for a couple of years to actually max out your benefits. So now we can see the market structure on the live market. We need to understand how the support and resistance work on these live markets. So as we saw here, we had a push down, push up, and a push down. So here we have basically a resistance on this downtrend. And as you can see, the price came to resistance and reacted down again. But the amount of volume wasn't enough to break this low here. So what it did, it created a break of structure. So the price basically broke through, okay, creating this low here that never got touched. And then the price went up, came down again, went up, and it broke through this level. And if we look closely, we can see that the price broke through this level, and it reacted. It reacted to the previous resistance and turned into a support. So as you can see, the price came up down here, creating this level here, pushed up, broke it down, and then pulled up again on this candle here, reacting to the support that was previous resistance and continued down. So this is how we can actually approach the markets using this system. Obviously, we are not going to be doing trading only based on this. We're going to have more concepts that we need to know, but this obviously are the basics. So now we know what candlesticks, support and resistance, market structure is. We need to understand something that's really important in the forex market, and this is the liquidity. Liquidity is basically a zone where price will approach to grab this liquidity and then go opposite. And we have a great example right at this moment here, where basically a liquidity is, we could call it in an easier way, where traders will place their stop loss and take profits. So if we have a range, okay, then basically we have the range that comes from up here and it ends down here. So basically what we can see is a nice range on this side here, where the price came up to here, came down here, came up again, come down, went up, come down. So basically everybody that has sold at this position here will probably have his stop loss here above, and everybody that has bought down here probably will have the stop loss here below, and everybody that sold at this point here might have his take profit just below there. So once we understand that, we can understand that above these levels there's money, there's liquidity, and the market is going to be interested to grab this liquidity for people that want to take profit, and for obviously people that unfortunately don't want to hit their stop loss. So now we have this. No, we actually know this. What we can see here is the market, how it reacted. Right when it went below this level here, we have this reaction here. Look how the price dipped into the zone, okay, breaking the zone, and had this massive green candle growing out, that then we can see a really slow retracement and pushing higher and higher. So this is basically taking the liquidity of this zone here. Now on this zone here, you can see something similar. The price came up, had a massive wick up and pushed down. It's pushed up again, but there wasn't enough buying power because the people are not interested anymore in buying in this level. And now the price started to retrace down, breaking this level, and might continue down here again. So we need to understand that when we have a range, we have liquidity sitting above and below. Obviously the market is going to end touching, and when it touches, we can see some type of reaction on that level. Obviously it's not always going to happen like this, because the market isn't perfect and everything doesn't have 100% guarantee that it's going to happen, but it's market conditions that tend to repeat, and that's what we need to look at and combine it with other ways that the market works to actually build our trading strategy. And something interesting, just so you can have an idea in your mind, the market is always going to be more or less 70% in range. So we're going to see these type of ranges like this. They can be bigger, they can be smaller, but it's always going to act in this range. And then we have more or less 30% of a trending market. So depending on the trading strategy that you're going to use, you're going to be looking for a trending market or for a ranging market. Obviously, if you have a strategy that works in a ranging market, you're going to get more trades. Meanwhile, if you are going to have a trading strategy that works based on trends, you're going to have less entries, less trades. And the last important thing that we need to know is that we can actually combine different time frames to actually have more confirmations when we're looking for a trade. And it's so simple as maybe having a 1 hour time frame and a 5 minute time frame to actually confirm this entry. The best thing to do is with a layout, basically having two layouts. We have 1 hour and we can have 50 minutes or 5 minutes, depending on our trading strategy and what gives us better statistics, what gives us better win rate and all that. So it's obviously, we're going to learn it in the future. But a very common practice is, let's say we have now a downtrend in terms of market structure. We have the low, the high low here, and we have the lower low here. So this is a downtrend in the 1 hour time frame. So we're going to be looking for entries, let's say in the 5 minute, on each pullback where the prices come down, pushed up. So we can enter in this place here, comes down again, pushes up, we can enter here, push down, we can up, enter here. And this is basically how we could use two different time frames. Obviously, there's millions of combinations of how we can combine one time with the other, but that's the actual basic of what we should be doing. It's always good to have at least 1 or 2 time frames above of your actually entry time frame, because this gives you higher confirmations. Because if the higher trend, if the 4 hour charts are in an uptrend, the 1 hour chart is in an uptrend, and the 5-minute chart is in an uptrend as well, then obviously we have a strong confirmation that this trend could continue higher up in the next hour, 2 hours, 3 hours. And now we finished the technical analysis part, we're going to head to the actual order execution. How do we execute the orders? How do we size them? How much percentage of our accounts we risk? And all that good stuff. So stay tuned and don't miss the next video, because obviously you need it to actually enter the market.